Amazon Web Services is the backbone of the modern internet. They are masters of logistics, accustomed to buying what they need exactly when they need it. But recently, they bypassed the open commodity markets to sign a direct private supply deal to secure their own copper. To get this metal, Amazon partnered with mining giant Rio Tinto to resurrect a facility in Arizona that hasn't produced copper in over a decade. They are actually using experimental bacteria and acid to leach copper out of low-grade rock that previous miners threw away as trash. They are going to these extremes because copper is the physical prerequisite for the entire digital economy, from server racks to power cables, and right now, the world is running out of it. When software companies are forced to dig through decade-old waste piles just to secure raw materials, the supply crisis is no longer a theoretical spreadsheet model. It is a harsh physical reality. The markets are reacting to this physical shortage. On the London Metal Exchange, copper prices recently surged past $11,000 per metric ton. This line graph tracks copper's historical price up to its recent peak. Looking ahead to 2026, J.P. Morgan projects an average of $12,500, while Citi's bull case reaches $14,000. The digital revolution is currently operating on a high-speed collision course with the strict physical limits of the Earth. Electrifying our infrastructure requires massive raw inputs. A single electric vehicle requires 3 to 4 times more copper than a gas-powered car, while offshore wind turbines require 4 to 5 times more copper per megawatt of power than a coal plant. Add to that a $400 billion upgrade to the U.S. power grid by 2030, plus the hyper-expansion of artificial intelligence data centers, which require thousands of miles of copper wiring for power distribution and cooling systems. Look at this area chart projecting out to 2050. The top curve is aggregate global demand, and the bottom curve is supply. The space expanding between them represents a projected global supply gap of 28 million metric tons. Mining production growth for 2026 is estimated at just 1.4%. When you compare that flat output to a demand curve that is climbing by 10 million tons annually, the existing global infrastructure fails to bridge the gap. The global energy transition possesses an exponential, insatiable appetite for this single physical element. If demand and prices are sky-high, why can't the market simply produce more? The primary friction is time. You cannot spin up a copper mine like a software update. Discovery, permitting, environmental reviews, and construction take a rigid 15 to 17 years before a single ounce of commercial copper leaves the ground. This visual comparison shows our geological reality. The high-yield, easily accessible copper is gone. Decades ago, miners extracted ore grades of 5%. Today, they're moving mountains for yields as low as 0.5%. Processing that much low-grade dirt requires massive capital. Mining giants like BHP are investing up to $10 billion into existing sites just to keep their annual production output completely flat. And all of that assumes everything goes perfectly. When a mudslide recently hit Indonesia's Grasberg mine, the second largest on Earth, months of global supply were wiped out instantly. Combine slow permitting, degrading ore quality, and random supply shocks, and the consequence is severe. Analysts expect a global refined copper deficit of over 330,000 metric tons to hit as early as 2026. Mining output cannot scale at the speed of software. It is strictly bound by the slow, unyielding physics of the Earth. To justify the massive expense of developing new, lower-grade mines, the market must correct itself. Analysts estimate the base price of copper must rise to around $7 per pound just to break even on new digs. That incoming price floor creates an inflationary squeeze. When raw wiring costs more, the premium ripples directly into the final price of everyday consumer electronics, electric vehicles, and housing. It is also redrawing global maps. Because of strict regulatory environments in places like Australia, billions of dollars in mining capital are shifting to South America or concentrating on subsidized domestic projects in the U.S. Investors are noticing. While gold often rises based on emotion, institutional money is moving into copper to capture a structural industrial supercycle. This metal now acts as a strategic bottleneck, dictating global power dynamics through its role in national energy security. We have limitless digital ambitions running headfirst into finite, slowly extracted physical resources.
This disconnect is forcing major tech companies to stop relying on the open market and start defensively hoarding raw materials through vertical integration. Without a radical acceleration in copper extraction, the physical infrastructure required to power the artificial intelligence boom and the green energy grid will physically halt. The future of technology is not written exclusively in software code. Its progress is tied to the physical availability